In 2025, the world is facing an unprecedented debt burden. According to the Institute of International Finance, global debt reached over $315 trillion by the end of 2024, the highest it has ever been in recorded history. That's more than 330% of global GDP. Governments, corporations, and households have all contributed to this massive buildup. But it's public debt, especially in advanced economies and emerging markets, that's raising the most alarms. The United States, the world's largest economy, now holds a national debt exceeding $34 trillion, with annual interest payments alone projected to surpass $1 trillion. In Japan, government debt is already more than 260% of GDP, the highest among major economies. And in Europe, countries like Italy and France are struggling to control ballooning deficits while navigating slower growth. But the debt crisis isn't limited to rich countries. Emerging markets like Argentina, Egypt, Pakistan, and Ghana are facing crushing debt loads as interest rates rise and foreign investors retreat. Many are locked out of global credit markets entirely, or forced to borrow at unsustainable rates. Private debt is also surging. In China, corporate debt has exploded to over 160% of GDP, fueled by years of state-driven infrastructure and real estate expansion. Meanwhile, household debt in countries like South Korea and Canada is nearing dangerous levels, with consumers borrowing heavily to afford homes, education, and living expenses. In short, we are living in a world addicted to debt, and the numbers are not slowing down. But the real question isn't just how big the debt is. It's whether this level of borrowing is sustainable or heading for collapse. The modern debt explosion began with the 2008 global financial crisis. When banks collapsed and credit markets froze, governments around the world responded with massive stimulus packages. Central banks slashed interest rates to near zero and began quantitative easing, creating trillions of dollars to buy assets and flood markets with liquidity. The goal was to prevent a total collapse, and it worked. But it also came at a price. Debt became cheap, abundant, and normalized. For the next decade, countries, companies, and consumers borrowed more than ever before. Governments ran persistent deficits to boost sluggish economies. Corporations used low interest rates to finance stock buybacks and acquisitions. Individuals took on bigger mortgages and more personal loans. Then came COVID-19, and the global debt clock went into overdrive. In 2020 alone, governments added over $20 trillion in new debt to finance emergency spending. This included stimulus checks, unemployment benefits, business bailouts, and public health infrastructure. Central banks printed money at a scale never seen before, not just in the US and Europe, but also in developing nations. In the US, for example, the Federal Reserve's balance sheet more than doubled between 2020 and 2022. The same trend played out in Europe, Japan, and even smaller economies. But what was meant to be temporary has now become permanent. As inflation returned in 2022 and interest rates began to rise, many governments were already locked into high levels of debt and couldn't easily reduce spending. Servicing the debt is now eating up a larger share of national budgets, especially in lower-income countries. In short, the global debt explosion since 2008, and especially after 2020, was the result of extraordinary crises, emergency responses, and a belief that debt-fueled growth could continue forever. But the world is now waking up to the limits of this model. For over a decade, the global economy lived in a world of ultra-low interest rates. Governments borrowed freely, businesses loaded up on cheap credit, and households financed homes, cars, and education at historically low costs. But that era is over. Starting in 2022, central banks across the world, led by the U.S. Federal Reserve, began one of the most aggressive interest rate hikes in modern history. The reason? Inflation. Prices were rising at their fastest pace in decades. To cool demand and bring inflation down, central banks raised borrowing costs. The U.S. Fed hiked its benchmark rate from near zero to over 5% in just 18 months. Similar moves followed in Europe, the UK, Canada, and even emerging markets. And the impact of these rate hikes on global debt? Massive. Suddenly, governments that once paid near zero interest on their debt are now facing much higher borrowing costs. In the U.S., interest payments on the national debt are projected to exceed defense spending for the first time in history. In countries like Italy, Japan, and the UK, debt servicing costs are crowding out spending on infrastructure, health, and education. For developing nations, the shock is even worse. Many low-income countries borrow in US dollars. When US rates rise, their repayments become more expensive, especially as their own currencies weaken. Countries like Ghana, Zambia, and Sri Lanka have already defaulted or restructured debt. Others are dangerously close. Private companies are also feeling the pain. Many firms that refinanced during the cheap money era must now roll over debt at much higher rates. That's already led to bankruptcies in sectors like commercial real estate and tech. And households. They're seeing mortgage rates spike, credit card interest soar, and loan affordability shrink. This is the interest rate shock, and it's forcing a global reckoning with the true cost of debt. While wealthy nations are struggling with ballooning debt, the real danger may be lurking in the global south. In many developing countries, the debt crisis is not just a looming threat. It's already here. As of 2025, more than half of all low-income countries are either in debt distress or at high risk of it. Countries like Sri Lanka, Ghana, Zambia, and Pakistan have already defaulted or are in the middle of complex restructuring negotiations. Dozens more are on the edge. What's driving this crisis? First, COVID-19 hit hard. Tourism collapsed. Exports fell. Government revenues dried up. And to survive, many countries borrowed. Fast. Then came Russia's invasion of Ukraine, which sent food and energy prices soaring, adding inflationary pressure to already fragile economies. Many nations had to spend more on subsidies, imports, and social protection, again turning to loans. But the real tipping point, the U.S. interest rate hikes. Much of the debt in developing countries is denominated in U.S. dollars, so when the Federal Reserve raises rates, two things happen. The dollar strengthens, and local currencies weaken. That makes dollar debt far more expensive to repay, especially for countries that don't export enough to earn foreign exchange. And here's the kicker. Many of these nations are now stuck in a vicious cycle. To repay old loans, they must borrow more. But lenders, seeing the risk, demand higher interest. That increases the burden and makes default even more likely. There's also a growing geopolitical layer. China has become a major lender to developing countries through its Belt and Road Initiative. But when defaults happen, China often insists on bilateral negotiations, making coordination with Western creditors, the IMF, and World Bank more difficult. As a result, restructuring is slower, messier, and more politically charged than ever before. Meanwhile, ordinary people suffer. Governments/subsidies cut jobs and raise taxes, all to stay afloat. In some countries, social unrest is already brewing. This isn't just an economic story. It's a humanitarian crisis in slow motion, one that could define the next decade of development. When people think of a debt crisis, they usually picture government budgets and sovereign defaults. But the most fragile parts of the debt pyramid may lie elsewhere, in corporations and households. Let's start with the corporate side. Over the past decade, companies around the world gorged on cheap money. Central banks in the US, Europe, Japan, and beyond kept interest rates near zero, encouraging businesses to borrow aggressively, not just to invest, but to buy back shares, pay dividends, and fuel acquisitions. Now, as rates rise, many firms are suddenly exposed. According to data from early 2025, global corporate debt exceeds $90 trillion, with a significant chunk due to be refinanced in the next 12 to 24 months. The cost of rolling over that debt has more than doubled in many markets. For highly leveraged companies, especially in real estate, construction, and tech, this is already triggering a wave of bankruptcies and credit downgrades. The recent collapses of major Chinese property developers and U.S. office real estate firms are just the beginning. But it's not just businesses. Household debt is also reaching new highs. In many developed countries, people borrowed heavily during the low-rate era to buy homes, cars, or simply to maintain living standards. In the U.S. alone, total household debt has crossed $17 trillion, driven by surging mortgage and credit card balances. As inflation bites and interest payments climb, consumers are feeling squeezed. Delinquencies on auto loans and credit cards are rising sharply, especially among low-income households and younger borrowers. In some countries, mortgage holders with floating rates are now paying double what they did just 2 years ago. This matters because consumer spending drives over 60% of global GDP. If households cut back due to debt pressure, the broader economy slows, leading to layoffs, weaker growth, and even lower government revenues. Worse yet, all of this debt is interconnected. If businesses default, banks take a hit. If households can't repay loans, the financial system gets stressed, and when asset prices fall, from real estate to stocks, the value of collateral evaporates, amplifying the crisis. In short, ignoring corporate and household debt would be a huge mistake. This layer of the crisis may be quieter than sovereign defaults, but it could prove just as devastating, especially if interest rates remain elevated. At the heart of the global debt crisis lies a deadly paradox. The very institutions tasked with protecting economic stability, the world's central banks, may also be making the situation worse. Since early 2022, central banks led by the U.S. Federal Reserve, European Central Bank, ECB, and Bank of England have raised interest rates at the fastest pace in over 40 years. Their goal? To fight inflation, which surged globally due to post-pandemic demand, supply chain disruptions, and Russia's war in Ukraine. By mid-2025, rates in many developed countries remain high, and inflation, while cooled, hasn't disappeared. But the side effects of those rate hikes are now showing. The tightrope walk central banks face an impossible trade-off. Keep rates high to tame inflation and risk triggering a deeper recession, mass bankruptcies, and a cascade of debt defaults. Cut rates too soon and risk reigniting inflation, eroding public trust, and losing credibility. This dilemma is particularly acute for the Federal Reserve. As the world's most powerful central bank, its decisions impact every country that uses or borrows in dollars. When the Fed raises rates, capital flows back into the U.S., draining emerging markets of investment and making their dollar-denominated debt far more expensive. The ECB's balancing act. In Europe, the ECB is struggling with a different problem: fragmentation. Countries like Germany want to keep rates high to combat inflation. But heavily indebted countries like Italy, Greece, and Spain are already feeling pain. High rates threaten their fiscal sustainability and could rekindle the Eurozone debt crisis. To manage this, the ECB is using tools like PEP, Pandemic Emergency Purchase Program, to support bond markets selectively, but critics argue it's a fragile compromise. Japan and China. A different path. Meanwhile, Japan has kept interest rates near zero for decades, but is now under pressure from inflation and a weakening yen. In contrast, China is cutting rates to stimulate its economy amid a property crisis and falling growth. But that divergence from global tightening adds pressure on its currency and capital outflows. A no-win situation. Central banks are often seen as independent and powerful, but in today's debt-laden world, their freedom is increasingly constrained. They are expected to fight inflation, support growth, avoid financial instability, and not crash bond markets, all at once. The painful truth is that interest rates alone cannot fix structural debt problems. And as debt levels keep rising, central banks may have to choose: accept higher inflation or risk a financial meltdown. Not all countries are equally exposed to the global debt crisis. In fact, some are dangerously close to the edge, while others have more room to maneuver. Let's map the emerging fault lines. 1. Low-income and emerging economies, the first to fall. The countries most vulnerable to a debt-driven collapse are low-income and emerging market nations, especially those with large external debts denominated in US dollars or euros. According to the IMF, over 60 low-income countries are now either in or at high risk of debt distress. That includes Zambia, Ghana, Sri Lanka, all of which have already defaulted in recent years. Pakistan, Egypt, Tunisia, struggling with debt repayments and IMF negotiations. Argentina, locked in yet another debt standoff amid triple-digit inflation and political crisis. These countries are facing a deadly combination of high borrowing costs as interest rates rise globally, strong dollar making debt repayments more expensive, falling revenues from weaker exports or tourism, and declining investor confidence. Many are being forced to cut subsidies, devalue currencies, and reduce spending, triggering protests, social unrest, and even regime change. 2. Frontier markets, capital flight and currency collapse. Next in line are the so-called frontier markets, economies that are more developed than low-income nations but still fragile. These include countries like Kenya, Nigeria, Vietnam, and Turkey. Most of these economies depend heavily on foreign investment and commodity exports. When global investors get nervous, money flows out, leading to sharp currency devaluations, higher inflation from imported goods, and rising costs to service foreign debt. Turkey, for instance, has seen its lira lose over 80% of its value since 2018. Despite recent reforms, debt service remains a huge concern, especially for private firms with dollar liabilities. 3. Developed nations not immune anymore. Even wealthy nations are not safe. The US, EU, and Japan may be able to borrow in their own currency, but with debt to GDP ratios above 100%, they face long-term risks. In the U.S., rising interest payments are crowding out public investment and fueling political gridlock. According to the Congressional Budget Office, interest on U.S. and federal debt will exceed defense spending by 2026 if trends continue. In Europe, countries like Italy and France are already under pressure from bond markets. If yields spike again, as they did during the euro crisis, the ECB may be forced to intervene. And Japan, with the highest debt-to-GDP ratio in the developed world, over 250%, faces a demographic time bomb. As its population shrinks and ages, who will fund its debt? 4. Private sector, the hidden domino. It's not just countries. The private sector from Chinese developers to U.S. tech companies, is now a major source of systemic risk. If they begin to default en masse, it could trigger a credit crunch, massive layoffs, and a broader market collapse, the global risk loop. In today's interconnected world, a crisis in one region spreads fast. A default in Africa weakens banks in Europe. A U.S. tech crash shocks pension funds globally. A Chinese property bust drags down commodity exporting nations. Debt is no longer just a domestic problem, it's a global contagion vector. As the global debt crisis deepens, one question becomes critical. Who will bail out the world this time? The answer is no longer simple. The post-World era, dominated by the IMF and World Bank, is now facing serious competition and controversy. 1. The IMF, the traditional firefighter, but under fire. The International Monetary Fund remains the go-to institution for debt-laden countries, offering loans, technical advice, and restructuring deals, but it's increasingly seen as a political actor. Critics argue that IMF bailouts often come with austerity strings attached, leading to deep cuts in healthcare, education, and fuel subsidies. Its governance is heavily US and Europe-dominated, with African and Asian countries having little say. Past programs in Argentina, Greece, and Pakistan have often failed to restore long-term growth. Even so, in 2023 to 2025, the IMF approved dozens of new loans, including major deals with Egypt, Pakistan, Kenya, and Zambia. It is still the first responder, but not always the most welcome one. 2. China, the silent lender, behind the curtain. In the last 2 decades, China has become the largest bilateral creditor to the developing world. Through its Belt and Road Initiative, it funded hundreds of infrastructure projects, from ports in Sri Lanka to railways in Kenya. But now, as those debts come due, China finds itself caught in a dilemma. It prefers quiet, closed-door restructurings, avoiding the IMF's public scrutiny. It often insists on repayment before agreeing to debt relief. It has no global coordination framework. Unlike the Paris Club of Western lenders, China has restructured or suspended over $50 billion in loans since the pandemic. But critics say it's not enough. Countries like Zambia and Ethiopia were stuck for years waiting for China to sign off on IMF deals. In this new debt world, China is a reluctant lender of last resort, powerful but opaque. 3. New players, India, Gulf states, and private lenders. A growing number of non-traditional lenders are entering the scene. India has quietly extended billions in emergency aid to neighbors like Sri Lanka and the Maldives. And Saudi Arabia, the UAE, and Qatar are stepping in with sovereign wealth funds to rescue allies and buy influence. Meanwhile, private bondholders and hedge funds, who now hold over 40% of developing world debt, are playing hardball, demanding full repayments or suing in court. This fragmentation makes debt resolution far more complicated than in past crises. There is no global referee, no shared rules, and no consensus on who should bear the losses. 4. The big shift from multilateralism to multipolar rescue. What's emerging is a multipolar financial safety net. It's not just the IMF anymore. It's a messy mix of multilateral banks, bilateral lenders, sovereign funds, and shadowy bondholders. This fragmentation could slow down rescue efforts, increase the risk of defaults, and deepen global divides between East and West, North and South. In short, the world has more lenders, but less trust. The numbers are alarming, the warnings are clear, and the fractures are visible. So what happens if the global debt system actually breaks? Economists, central banks, and international institutions are now preparing for scenarios once considered unthinkable. 1. Sovereign default contagion. The worst-case scenario is a wave of sovereign defaults. If multiple countries, especially large emerging markets like Turkey, Argentina, or Egypt, default within a short period, the ripple effects could be global. Currency collapses in dozens of countries. Rapid capital flight from developing economies back to the US or EU. A sharp increase in interest rates for emerging market debt. Social unrest due to collapsed subsidies, inflation, and job losses. This is the nightmare the IMF, World Bank, and G20 are desperately trying to avoid. But the risks are rising, especially if global interest rates stay high. 2. Banking crises in emerging markets. Many developing countries have forced their central banks and domestic banks to buy government debt. If those governments default, the local banking system could collapse too. Countries like Nigeria, Pakistan, and Ghana face the twin threat of sovereign debt default and a banking crisis triggered by the write-off of government bonds. This could lead to credit freezes, business shutdowns, and mass unemployment, triggering wider political instability. 3. The US dollar and a liquidity squeeze. Most global debt, even outside the US, is still denominated in US dollars. That means when the dollar rises, as it has since 2022, the cost of debt explodes for everyone else. If there's a dollar shortage, countries scramble for dollar liquidity to pay interest. Imports of food, fuel, and medicine become unaffordable. The IMF must deploy emergency dollar credit lines to prevent collapse. The U.S. Federal Reserve has already opened swap lines with key central banks, but for most countries, they're on their own, and $1 crisis away from disaster. 4. Geopolitical fragmentation of rescue mechanisms. With China, the US, the Gulf, and others all playing their own debt games, coordination is breaking down. This can lead to countries forced to choose sides, West-backed IMF deals or China-backed bilateral relief. Slow, chaotic restructurings like in Zambia, Sri Lanka, and Ghana. Distrust between creditors leading to stalemates and further economic damage. In short, the world's safety net is fraying, just when it's most needed. 5. The climate debt collision. As the debt crisis worsens, many vulnerable countries are diverting funds away from climate adaptation and infrastructure just to stay solvent. This is especially dangerous in small island nations facing rising seas, African states hit by droughts, floods, and extreme heat, South Asian countries exposed to monsoons and cyclones. The fear is that climate-vulnerable nations will fall into a vicious cycle: climate disaster, economic shock, more borrowing, deeper debt, less resilience. In sum, the world is facing a historic stress test of its global financial architecture, and no one, not even the largest economies, is immune to the consequences if the system breaks. With debt soaring and risks mounting, the world is entering dangerous territory, but it's not all doom. Policymakers, economists, and institutions are now urgently debating how to fix the global debt crisis before it spirals into collapse. 1. The case for debt relief and restructuring. Many developing countries simply cannot pay what they owe. The first step, experts argue, is a global framework for debt restructuring that is faster. Current negotiations take years. Fairer. All creditors, public, private, Chinese, Western, must share the burden. Transparent. No more secret deals or bondholder power games. The G20 Common Framework was meant to solve this, but it's been slow and chaotic. Countries like Zambia, Ethiopia, and Sri Lanka have waited years for meaningful progress. Calls are growing to rewrite the global debt playbook, making restructuring less of a punishment and more of a reboot. 2. Increasing SDRs and emergency funding. The IMF's special drawing rights, SDRs, are global reserve assets, essentially free money for member countries. In 2021, the IMF issued $650 billion in SDRs, offering breathing room during the pandemic. Now, economists are pushing for another round, and for rich countries to donate their unused SDRs to low-income nations. Others propose new emergency lending programs not tied to harsh austerity measures. The idea: prevent defaults now, then reform debt systems once the panic has passed. 3. Reforming the global financial architecture. The current system was built after World War II for a very different world. Many say it's time to modernize. Give emerging economies more power at the IMF and World Bank. Build a new sovereign debt resolution mechanism like bankruptcy for countries. Create rules for fair burden sharing between private and public lenders. Without reform, global inequality could deepen, and more countries could turn to non-Western alternatives like Chinese or Gulf funding outside existing institutions. 4. Tying debt to climate action and development. Some solutions go beyond finance. There's a growing push to tie debt relief to climate goals. The idea is, forgive part of a country's debt if it uses the savings for renewable energy, reforestation, or climate resilience. This is already happening. Barbados restructured debt in exchange for coral reef protection. And the Bridgetown Initiative, backed by the UN, is pushing to link climate justice with debt justice. Similarly, debt for development swaps are being explored, helping nations invest in health, education, and green infrastructure while lightening their debt burdens. 5. A shift in mindset, from punishment to prevention. The biggest change may be psychological. For decades, debt crises were seen as the fault of poor countries mismanaging their finances. But now, it's clear. Global interest rates, pandemics, climate shocks, and financial inequality have all played a role. What's needed is a shift in mindset, treating debt not as a moral failure, but as a systemic issue that requires coordination, empathy, and smart economics. If the world can embrace this, the current crisis could become a turning point, not just for stability, but for a more just and sustainable global economy.